Hello, everyone, and welcome back to Synaptic Investing. I hope you're having a fantastic week and are ready for another deep dive.
We are definitely back at the desk. The coffee is piping hot, and we are ready to break down a company that is really flying under the radar for most retail investors right now.
Yeah, today we're breaking down one of the most interesting companies on the market, Accelerate Energy, ticker symbol EE. Currently trading around $42 with a market cap of about 1.34 billion. So think of them as the fast casual giant equivalent of the energy world, specifically dealing in flexible LNG solutions.
It's a fascinating piece of the global energy puzzle for sure.
Right, and on the surface, this looks like a vital infrastructure play with massive margins and sovereign government contracts. But the real question for us as long-term investors is this. Are the moat and the 47% gross margins durable, or are we looking at a cyclical peak about to face a wave of commoditization? That's what we're here to find out.
That's a huge topic. Before we dive deep, a quick heads up for the audience.
Right, if you're looking to invest, we use Interactive Brokers. Use the link in the description for a stock bonus when you sign up.
It's the best way to get a bonus and support the channel at the same time.
And while you're there, please like, subscribe, and let us know your questions in the comments.
Now let's get into it. Pillar number one, the business model.
Yeah, let's start with what we've been calling the black box. Because when people hear Accelerate Energy or they pull up the ticker EAE, I think the default assumption is that this is an exploration and production company.
Oh, 100%. People think they're out in the Permian Basin drilling holes in the ground or, laying traditional cross-country pipelines.
Which is completely wrong. If you buy this stock thinking you are buying a driller, you have fundamentally misunderstood the asset you own.
You're essentially looking at the wrong map. They don't pull gas out of the ground. They are a logistics and infrastructure provider.
Exactly. Their core business, the bread and butter, is what they call flexible liquefied natural gas solutions, which I know is a lot of corporate jargon. So let's strip it down to the actual physical asset, the FSRU.
The floating storage and regasification unit.
Which is really just a fancy engineering term for a massive, highly specialized ship.
It is a massive ship, but calling it just a ship is, it's a bit like calling a nuclear submarine just a boat, right? It's a ship with a colossal high-tech chemistry set welded to the deck. And to understand why that have any value at all, you really have to understand the physics of natural gas.
I'm glad you brought that up because I think a lot of investors take for granted how gas actually gets from point A to point B. Walk us through that global supply chain.
Okay, so natural gas comes out of the ground in a gaseous state. It's highly voluminous. You can't just put it in a bucket or the standard cargo container. So if you want to move it across an ocean, say from a massive export facility on the U.S. Gulf Coast all the way over to Europe or from Qatar to Bangladesh, you can't use a pipeline.
Right, the oceans are too deep, the distances are too far.
Exactly. So you have to liquefy it. You have to freeze this gas down to negative 160 degrees Celsius.
Which is just an unfathomable temperature to maintain.
It is. It's cryogenic. But when you do that, the physics are incredible. The gas shrinks. It takes up about 1/600th of its original volume. It literally turns into a dense liquid. Then you pump that liquid onto a specialized LNG transport tanker. Think of it as a giant floating thermos bottle, and you sail it across the ocean.
But here is the massive bottleneck in that whole system. When that thermos bottle arrives in, say, a port in Brazil or Bangladesh, you can't just pour that cryogenic liquid directly into the local power plant.
No, absolutely not. The power plant turbines burn gas, not negative 160-degree liquid. So you have to warm it back up. You have to regasify it.
And historically, how has the industry solved that?
Traditionally, you build a massive onshore terminal. You buy coastal land, you pour millions of tons of concrete, you build these enormous storage tanks, massive heat exchangers, intricate pipeline networks.
And those onshore terminals are total nightmares to get off the ground.
They are civil engineering behemoths. They cost billions of dollars to build. They take 5 to 7 years just to get the permits and do the environmental studies, let alone the construction. And frankly, nobody wants them in their backyard.
The classic NIMBY factor, not in my backyard.
Right. And this is exactly where Accelerate Energy enters the chat and disrupts the whole model. They basically say to these countries, hey, don't pour the concrete, don't wait 7 years, we will just bring the terminal to you.
It's a plug-and-play solution.
That's the pitch. They park this massive FSRU just off the coast. It acts as the dock. Those transport tankers we talked about, they pull up right alongside the Accelerate vessel, transfer the liquid LNG onto the FSRU, and then the FSRU uses onboard systems to warm up that liquid, turn it back into gas, and push it through a high-pressure hose directly into the country's grid.
So it's a shortcut. They are selling time.
They are selling speed and flexibility. If you are a rapidly developing nation or even a massive European utility during the Ukraine gas crisis, and you need energy security right now because of a geopolitical shock, you cannot wait 5 years. You might not even have 5 months. Accelerating pulls up, plugs in, and you literally have energy security in a matter of weeks.
And that distinction is so crucial for investors to grasp. Because selling time and national security, rather than just selling maritime transport, completely changes the business model.
It completely changes the quality of the revenue because a standard shipping company, like a generic oil tanker or a dry bulk carrier, lives and dies on the spot market.
Right, the Uber pricing model.
Exactly. If there is a shortage of ships globally, the day rates go to the moon. But if there are too many ships, the rates crash to basically zero. It's highly volatile. It's essentially gambling on global macro trends. Accelerate doesn't play that game. They sign long-term, fixed-rate time charters.
Explain a time charter for the listener who maybe doesn't have a background in maritime law.
Yeah, think of it like the difference between a hotel room and a commercial lease. A hotel room is the spot market. The price changes every single night based on occupancy and demand. A time charter is a 10 or 15-year commercial lease. Accelerate leases this floating infrastructure to a sovereign government and says, we will park our vessel here for the next decade. You pay us X amount of dollars per day, every day, regardless of whether you actually use the gas that day or not.
So they are functioning as an infrastructure landlord.
Correct. The revenue is recurring. It gives you incredibly high visibility into their future cash flows. It looks a lot less like a cyclical shipping company gambling on daily rates and a lot more like a regulated utility simply collecting rent.
But here is where the numbers get absolutely wild and why we had to do this deep dive. When you look at their unit economics, the recent margin expansion is just startling. This isn't just steady rent collection. Something fundamentally shifted under the hood recently.
It is the first thing that jumps off the page when you open their 10K. If you look back at 2022, their gross margins were sitting at a pretty uninspiring 14.4%. That is a thin, low-quality business profile.
And then you fast forward to the trailing 12 months leading up to right now, February 2026.
We are looking at gross margins of roughly 47.9%.
That is a massive, massive move. We're talking about a more than tripling of gross margins in roughly 4 years. How does that even happen in a heavy industry? Usually in the industrial sector, margin expansion is a war of inches. You fight for 0.5% here, 0.25% there.
It proves that they have pricing power, period. You don't get that kind of multiple expansion on your margins just by getting lucky with fuel costs. It suggests that despite all the inflationary pressures we've seen, the rising cost of specialized crew, dry dock maintenance, steel, marine insurance, they were able to pass every single cent of that inflation onto the customer and then tack on a massive premium on top of it.
And they optimize their asset utilization.
Right. Back in 2022, they might have had certain vessels sitting idle or experiencing downtime transitioning between short-term contracts.
Yeah.
Now, basically every asset in the fleet is working and generating cash.
And that nuance is critical for the bull thesis. Because if they were just a commodity shipping vendor imagine a guy with a pickup truck who helps you move a couch. Margins would stay thin because there's always another guy with a truck who will do it for $5 cheaper. But 48% margins. That tells me they're acting like vital, irreplaceable infrastructure. When you are the only physical asset keeping the lights on in a developing nation, you have incredible leverage at the negotiating table.
You have leverage and you have scarcity value. But we have to be objective here. Margins that high act like a massive signal flare to the rest of the market.
A signal flare for what? Competitors?
Absolutely.
Yeah.
As the old saying goes in capitalism, your margin is my opportunity. If you are making nearly 50 cents of gross profit on every dollar of revenue in what is ultimately a maritime asset business, I'm going to go out, raise some capital, and try to do it for 40 cents on the dollar just to steal your market share.
Which transitions us perfectly into pillar number 2, the moat versus the anti-moat. Because having high margins today is great, but as investors, we only care if they can protect those margins tomorrow. Do they actually have a structural moat, or are we looking at a mirage?
Let's start with the bull case on this, which revolves heavily around switching costs.
The plug-in effect. I honestly think this is the strongest possible argument for owning Accelerate. We talk about switching costs a lot in the software space, like how hard it is to switch a whole company from Microsoft to Apple, but it applies beautifully to physical infrastructure too.
I agree. You have to look at the actual physical projects they operate, like the terminal in Iraq or their setup in Bahia, Brazil. These aren't just independent ships dropping off a package at a public dock and sailing away. They are highly integrated terminals.
Explain that integration a bit more, because I think people picture a ship just tying a thick rope to a wooden dock and throwing a rubber hose over the side.
It's exponentially more complex than that. Once that Accelerate FSRU is docked, it physically connects to specialized high-pressure gas arms. Those arms feed into a subsea pipeline or a dedicated jetty. That pipeline then feeds directly into a highly calibrated onshore metering station, and that metering station feeds into the national power grid.
So it's a hardwired connection.
It's hardwired physically, but also digitally and procedurally. The software systems on the ship have to talk seamlessly with the grid software. The gas pressure protocols have to match perfectly to avoid blowing out a pipeline. The local onshore engineers are extensively trained on Accelerate's specific proprietary safety protocols.
So it's not just a physical connection at all. It's an entire procedural and operational web that gets spun around this vessel.
It's incredibly sticky. I mean,
Yeah.
put yourself in the shoes of the energy minister of a country like Bangladesh.
Yeah.
You have Accelerate parked off your coast. The natural gas is flowing, the power plants are running, the national grid is stable. Then, along comes a competitor, let's say an aggressive Greek shipping magnate, who says, hey, I can bring a newer FSRU here and charge you 5% less per day on the charter rate.
Right. As the minister facing a tight budget, do you take that deal?
You'd be absolutely insane to take that deal. Because to switch vendors, you have to physically disconnect Accelerate. That means shutting down the gas flow. That means downtime. And in the energy sector, downtime means rolling blackouts, and blackouts mean riots in the streets.
And usually political suicide for whoever is in charge.
It's exactly. The political and economic cost of a nationwide blackout is essentially infinite. The financial savings from switching to a slightly cheaper vessel are marginal. That dynamic creates an incredibly sticky customer base. Accelerate isn't just a vendor. They become embedded in the fundamental energy security of the host nation.
It really does remind me of sticky enterprise software. Once a massive corporation installs SAP or Salesforce, they almost never leave, because ripping the system out by the roots is just too painful and risky. Accelerate is essentially the Salesforce of floating gas terminals.
That's the bull case in a nutshell, and it's undeniably strong. But as analysts, we have to flip the board around. I got to play the challenger here and look at the anti-moat. Because at the end of the day, if we strip away the long-term contracts, the software integration, and all the fancy acronyms, the core asset is still just a ship.
Right, it's welded steel floating on salt water. It's not a patented pharmaceutical drug that literally no one else is legally allowed to make.
And unlike proprietary software code that is locked behind trade secrets, other people can absolutely build these FSRUs. The shipyards in South Korea, places like Hanwha Ocean or HD Hyundai Heavy Industries, they have the blueprints. They will happily build a state-of-the-art FSRU for anyone who shows up with a large enough checkbook.
So the barrier to entry isn't some insurmountable technological hurdle. It's just access to capital.
And in global shipping, capital is often very abundant. We are actively seeing more traditional shipping companies ordering FSRUs right now. The global order book for these vessels is growing.
So the existential threat here is commoditization. If the global supply of these vessels suddenly floods the market, the vessel charter side of the business, just renting the boat out, becomes a brutal race to the bottom on pricing.
Precisely. If there are 10 empty, newly built FSRUs sitting idle in the Atlantic Ocean aggressively looking for work, Accelerate can't walk into a negotiation and command 48% margins anymore. They lose their pricing power. They go from being a price maker to a price taker. That is the core vulnerability of the business model.
So the obvious question is, how is Accelerate management fighting back? Because they aren't blind to this dynamic. They know better than anyone that maritime shipping is a notoriously cyclical industry. They know they can't just rent boats forever and expect to maintain utility-like multiples.
They are pivoting, and I would argue this is the single most important strategic shift for any prospective investor to understand about this company right now. They are aggressively moving away from simple charter contracts and toward what they call integrated projects.
I think the situation in Jamaica is the perfect blueprint for this strategy.
Yes, the Jamaica acquisition is the prime example. In that specific deal, They didn't just sail a ship down there and rent it to the local utility company. They actually acquired the downstream power value chain.
Wait, so they own the natural gas molecule, the ship that regasifies it, and the physical pipeline that goes directly into the local power plant.
Essentially, yes. They are moving structurally closer to the electron. They want to be involved in the actual power generation side of the equation. And this strategy widens their economic moat significantly. Because it's one thing for a country to replace a maritime vendor who just rents them a floating storage tank. It is an entirely different, almost impossible task to replace the company that physically owns the onshore infrastructure and manages the entire fuel supply chain. That is the only viable way they can escape the crushing gravity of the traditional shipping cycle.
It sounds like they are trying to graduate from being a trucking company that just hauls goods to actually owning the highway itself.
That's a fantastic analogy. A trucking company is a pure commodity business. You compete entirely on cost per mile. But a toll road is a monopoly. They are spending money to become the toll road.
But owning the toll road is incredibly expensive. Building out downstream infrastructure requires a massive amount of upfront cash, which brings us to the actual financial health of the company today. Let's move to Pillar 3, financial resilience and the quality of earnings.
We always call this the quality of earnings test, because a company can put whatever headline numbers they want in a press release, but we have to ask, are those numbers real? Or are they just accounting fiction?
Well, looking at the income statement, their operating margins have expanded to roughly 25.2%. That's a completely different beast than what this company looked like a few years ago. It really reflects that mix shift you were talking about. More integrated projects, better, longer-term contract terms.
But I want to hit on something that we talk about constantly on this channel, and that is stock-based compensation, or SBC.
The silent killer of retail shareholder returns.
It really is. We analyze so many high-growth tech companies and even some supposed industrial growth stories where management reports a fantastic adjusted EBITDA number. But then you look closely at the cash flow statement, and you realize they are paying their executives and engineers hundreds of millions in stock. They are heavily diluting you and me every single quarter just to make their operating expenses look artificially low. It's a massive hidden expense.
It's essentially management looting the company from the inside while claiming to the public that they are highly profitable. They are paying everyday salaries with your shareholder equity instead of their own cash. So when you ran the numbers, how does Accelerate stack up on the SBC front?
They pass with flying colors. I was actually genuinely surprised by how clean this particular metric was for them.
Break the actual numbers down for us.
Okay, so if you look at their operating cash flow, it comes in at roughly $244.4 million. Against that, the stock-based compensation expense is only about $10.6 million.
Wow. That is almost negligible in the grand scheme of things.
It's about 4.3% of operating cash flow. In the software and tech world, we routinely see companies where SBC is 20, 30, even 40% of cash flow. Even in standard industrial companies, 10 to 15% isn't uncommon. For Accelerate to be running under 5% tells me that the management team is fundamentally aligned with outside shareholders. They aren't treating the company's stock ticker as their own personal ATM machine.
That is a huge green flag for corporate governance. It means when they issue an earnings report and say they made $1 of profit, they actually made a real dollar. Now, let's look at the cash engine itself, free cash flow conversion. Because as we always say, EBITDA is just an accountant's opinion, but cash in the bank is a fact. How much of that headline EBITDA actually makes it through to the bank account?
We tracked roughly $213.5 million in pure free cash flow against a reported EBITDA of $319.3 million.
So if you do the division there, that's a free cash flow conversion ratio of roughly 66.8%.
Is that a good number in this space?
Under our internal framework, for a heavy industrial infrastructure company, that is excellent. We usually look for a target conversion rate of somewhere between 50 to 70% for asset-heavy businesses.
Why is the bar so much lower for industrials than it is for, say, a software-as-a-service company?
Because software code doesn't rest. Accelerate has to constantly maintain massive steel vessels in highly corrosive saltwater environments. They have mandatory dry docking costs every few years where they have to pull the ship out of the water. They have significant ongoing maintenance capital expenditures just to keep the assets safe and certified. For a company with that much physical iron in the water, converting essentially 2/3 of your EBITDA into actual spendable free cash flow is an incredibly efficient operation.
It reinforces the idea that the earnings are high quality. It's not just depreciation tricks or working capital manipulation.
Correct. But in investing, there is always a but. We have to talk about where that cash actually goes once they generate it, because generating free cash flow is only step one. Investing that cash intelligently back into the business to create more value is step two. And this leads us directly into pillar 4, capital allocation and the ROIC trap.
The wet blanket on the bull thesis.
I hate to be the buzzkill here, but this is exactly where the whole utility fortress narrative hits a massive brick wall. We have to talk about return on invested capital, or ROIC.
This is arguably the most important metric for identifying long-term compounders, right?
Absolutely. If you want a stock to go up 10 times over a decade, a structurally high ROIC is almost a mathematical requirement. It essentially measures how talented the management team is at taking a dollar of investor capital and turning it into a recurring dollar of profit.
So walk us through the Accelerate report card on this front.
It's not great. The return on equity is currently hovering right at 8%, and the return on assets is even lower at about 5.3%.
Okay, looking at that in a vacuum, 8% doesn't sound completely terrible. I mean, it's a positive number. They aren't losing money.
It's positive, yes, but is it actually sufficient to create shareholder value? To answer that, you have to compare their return on capital to their cost of capital.
The WACC.
Exactly, the weighted average cost of capital. Think of the WACC as the baseline hurdle rate a company has to clear just to break even in economic terms. It's a blended rate of the interest they pay on their corporate debt, combined with the annual return that equity shareholders realistically expect for taking on the risk of owning the stock. So, in our current macro environment, with interest rates where they are, what is Accelerate's likely WACC?
Well, corporate debt certainly isn't cheap anymore. Given their risk profile, their true cost of capital is likely sitting somewhere close to 8, maybe even up to 9 or 10%.
So let's just do the basic math on that. If it costs the company 9% in interest and equity premium just to get their hands on a dollar of capital, and then they take that dollar and invest it into a new ship that only generates an 8% return, what are they actually doing?
They are basically burning the living room furniture just to heat the house. They are actively destroying shareholder value with every new investment.
Slowly, perhaps, but yes. They aren't compounding your wealth. They are running on a financial treadmill. And this is the ultimate curse of heavy industry. Those FSRU ships are phenomenally expensive. We're talking $300, maybe $350 million a pop for a new build. The capital base required to operate is just so incredibly heavy that it permanently drags down the percentage returns.
This brings up a theoretical concept we were discussing off-camera in our prep meeting, the reflexivity loop. This is based on a mental model popularized by George Soros, right?
Exactly. Most retail investors tend to think that a company's stock price simply acts as a mirror that reflects the underlying health of the business. Soros argues that in certain situations, the stock price itself actually changes the fundamental reality of the business.
Explain how that theory applies specifically to Accelerate.
Well, Accelerate is a highly capital-intensive business. If they want to grow their earnings, they need a lot of money. They need to go out and buy more ships, like their recent order for the Accelerate Shenandoah, or they need to acquire massive downstream power terminals. They physically cannot fund that level of rapid expansion purely out of their own internal cash flow because the individual assets are just too expensive.
So they have to tap the capital markets. They have to raise outside money.
Right. They either have to issue new shares of equity or they have to borrow heavy debt against their existing equity valuation.
So the reflexivity loop essentially works like this. A high surging stock price allows the company to raise new capital very cheaply. That cheap capital allows them to go out and buy more revenue-generating assets. Buying more assets creates top-line growth. And the market sees that top-line growth and pushes the stock price even higher.
It's a beautiful, virtuous cycle on the way up. That is exactly the playbook Tesla used for years to build their gigafactories. That's what Amazon did in the early days to build out AWS.
But the Soros model works in reverse, too.
And that's the grave danger here. That is the reflexivity trap.
If the stock price tanks for whatever reason,
then their cost of equity capital immediately spikes. Suddenly, it becomes mathematically dilutive to issue shares to buy the next ship. So the growth engine just completely seizes up. The market looks at the next quarter, sees no new growth on the horizon, and so investors sell the stock. The stock drops even further, making capital even more expensive. It becomes a vicious, self-fulfilling death spiral.
So unlike a lean software company that can theoretically double its revenue just by having 10 engineers write better code in a basement, Accelerate is fundamentally dependent on the ongoing goodwill of the capital markets just to survive and expand.
They are completely addicted to external capital. And that makes the daily stock price itself an operational piece of their business model. If the stock falls too low and stays there, the actual underlying business objectively gets worse because they get priced out of future growth.
Let's look at their current capital allocation priorities then. How are they deploying the cash they do generate? We know they are currently paying out a dividend.
Yeah, it's about 32 cents annualized. It's nice to get a little check in the mail. It provides a little bit of yield, but it's certainly not the main show here. Management is clearly prioritizing organic growth projects, like expanding the terminal in Iraq and strategic M&A, like the Jamaica deal we talked about.
This push for aggressive global expansion, does it worry you from a capital discipline standpoint?
It's a double-edged sword. On one hand, it implies a very execution-focused, hungry corporate culture, which is good. You need to be aggressive and fast-moving to win these massive complex deals in places like Bangladesh and Brazil against national oil companies. But as analysts, we have to constantly watch for the classic trap of empire building.
Meaning management growing the company just for the sake of being big.
Right. Let's be honest, CEOs inherently love to run bigger companies. A bigger company usually means a bigger base salary, more prestige, a larger private jet. But if you are a CEO going out and buying hundreds of millions of dollars in new assets that only return 6% just to make your top-line revenue chart go up and to the right, you are actively hurting the retail shareholder. We need to see Accelerate buying assets that drive that core ROIC metric up, not just buying assets to boost top-line revenue.
So we basically need them to be highly disciplined allocators. Don't just blindly buy more ships because you can. Buy highly profitable integrated projects.
Exactly. Quality of return over sheer quantity of assets.
So given all of that complex context, the incredibly strong gross margins, the somewhat weak ROIC, the reflexivity risks tied to their capital needs, what is this entire enterprise actually worth today? Let's transition to Pillar 5.
Valuation.
The ultimate Shoney story.
The stock is currently trading right at $42 a share. That gives us a forward price-to-earnings ratio of right around 15.3 times next year's earnings. And a 15 times multiple on a heavy infrastructure asset it's very reasonable. It's almost in valuation limbo. It tells me that the broader market expects total stability, expects steady mid-single-digit growth going forward. It is absolutely not priced like a hyper-growth tech flyer, but it's also clearly not priced for imminent bankruptcy either.
It's basically sitting right in the middle of the fairway.
It is. But as disciplined investors, we don't buy stocks just because the price seems reasonable. We want to try and calculate an intrinsic fair value.
We actually looked at 3 completely different valuation methods to try and triangulate the truth here.
Right. Let's start with method A, which is basic mean reversion. If you look historically, since this company had its IPO, the stock is traded at an average multiple of roughly 21 times earnings.
You have to admit, though, that 21 multiple was achieved during the initial hype phase, right after they went public, and right in the middle of a global energy panic.
That is entirely true. It might be an inflated baseline. But if you play devil's advocate and apply that historical 21 multiple to the current Wall Street consensus estimate for 2026, which is about $2.10 per share in earnings, you get a target price of roughly $44.10.
So basically barely any upside from the current $42 price. You're looking at maybe a 5% return.
Very unexciting. That alone tells me the initial IPO hype premium has completely evaporated. Now, let's look at method B, which is the street consensus. What do the professional Wall Street analysts who cover the stock day in and day out actually think it's worth?
The current average analyst price target is $38.67.
Wait, let's pause on that. The stock is currently trading at $42, but the paid experts covering the sector say it's realistically only worth $38.
Yeah, that suggests the stock is slightly overvalued right now.
Mm-hmm.
The retail market has actually gotten a little bit ahead of the professional analysts' models.
That's a definite yellow flag for me. It means the future growth expectations currently baked into the $42 price tag are actually higher than what the professionals think the company can realistically deliver.
And then there's method C, the owner earnings approach. This is essentially the Warren Buffett style of fundamental analysis.
This is always my favorite way to look at a business. Let's completely ignore the PE ratio, ignore market sentiment, and just look at the raw cash generation. Let's assume, based on their contracts, that they can reliably generate about $180 million in normalized free cash flow year in and year out. Now, I'm actively discounting their recent peak cash flows a bit just to be safe, assuming those 48% margins eventually come down slightly as competition enters.
Okay, so we are assuming a highly reliable $180 million in the bank every year.
Right. Now, if we apply a standard 10% capitalization rate to that cash stream, basically saying, as investors, we demand a 10% annual return on our money to take on the risk of owning the specific business, then the entire enterprise is worth about $1.8 billion.
And if you take that $1.8 billion and divide it by the current outstanding share count,
That math works out to roughly $55 per share.
okay, so we have a pretty wide dispersion here. The pessimists on Wall Street say it's worth 38. The more optimistic, pure cash flow models say it could be worth 55.
Which puts the true fair value range somewhere broadly between $38 and $50. And right now we are sitting at exactly 42.
It feels almost perfectly annoyingly efficient.
It is fairly valued. The market has priced it correctly. And as value-oriented investors, we really don't like buying things that are just fair. We want things that are cheap. We want a distinct margin of safety.
Because if you pay absolute fair value today, and then next year something goes wrong, a key ship breaks down, a major government contract gets surprisingly canceled, you instantly lose money. You have no downside protection.
Exactly. If you buy a dollar bill for 50 cents, you have a massive buffer if things go wrong. Here, at $42, there is zero buffer.
So what's your actual buy zone for this ticker?
For me to get genuinely interested, to really feel like I have adequate mathematical protection against that low ROIC trap we discussed earlier, I would want to see this stock drop down to the $32 to $35 range.
So at today's price of 42, you feel like you're paying full retail price at the mall.
You're paying absolute full price for a high-quality asset, yes, but you certainly aren't getting a bargain. And in a highly cyclical, capital-intensive industry like maritime shipping, you really, really want a bargain before you commit capital.
So before we wrap up the analysis, we have to look closely at the potential downside. We touched on elements of it, but let's formalize the bear case. Pillar 6, the risks.
We like to call this the pre-mortem exercise. Let's assume we buy the stock today, and we fast forward to the year 2028, and we look at our portfolio, and we've lost half our money on Accelerate. How exactly did that happen?
The inversion filter. I love doing this exercise. It forces you to look at the ugly side of the thesis.
Risk number one absolutely has to be geopolitics.
Without a doubt. Just look at a map of where their key assets are deployed. Bangladesh, Iraq, Pakistan, Brazil, Argentina. These are what you might call tough neighborhoods geopolitically.
Right. These aren't necessarily unstable in the sense of total constant chaos, but they have very high levels of historical, political, and economic volatility.
Right. So what is the nightmare scenario? Expropriation.
Right.
Or sudden regime change. Imagine a fragile government falls in one of these host countries. A new radical regime comes into power, perhaps one that runs on a platform of being highly hostile to Western corporate interests. And they simply say, you know that lucrative 15-year time charter you signed with the previous administration? We aren't honoring it. That floating terminal in our harbor is essentially nationalized now.
Or even more likely, they don't seize the asset. They simply stop paying you in US dollars.
Ah, the currency risk. That is huge. Accelerate's entire balance sheet. All their corporate debt is denominated in US dollars. But their clients operate in local currencies. If a host country like Pakistan runs critically low on foreign US dollar reserves and tries to force Accelerate to accept payment in a heavily devalued local currency, Accelerate takes a massive immediate haircut on their real earnings.
And since the massive mortgage on the ship still has to be paid back to the bank in US dollars.
That is a total catastrophe. It's an instant wipeout of their free cash flow margin. They could technically be profitable on paper, but unable to service their own debt.
Which leads us right into risk number two, the capital markets freeze.
We touched on this earlier with the reflexivity concept. They fundamentally rely on smooth, functioning credit markets to finance these $300 million vessels.
Right. What happens if we get another 2008-style financial crisis? Or even just a repeat of the 2022 regional banking liquidity crunch?
If the global credit markets suddenly seize up, or if the Federal Reserve is forced to spike interest rates even higher to fight a second wave of inflation, Accelerate might find themselves completely unable to refinance their existing debt at manageable rates. Or worse, they can't secure the funding needed for their new, integrated growth projects.
The liquidity just completely dries up.
And the entire growth story ends literally overnight. If they can't borrow cheap money, they can't build new terminals. If they can't build, the Wall Street analysts revise their growth models down to zero, and the stock's multiple collapses.
And finally, risk number 3, the red team challenge. I want you to give me the absolute strongest bear argument against this company, the fundamental thesis that keeps you up at night as an analyst.
It has to be the cyclical trap.
Break that down for the audience.
The core argument is this. Accelerate, despite all the integrated project narratives, is ultimately just a specialized shipping company that is currently enjoying a temporary massive cyclical peak. The 2022 European gas crisis, caused by the war in Ukraine, created a global panic for energy security. Everyone suddenly needed FSRUs at the exact same time. Charter rates skyrocketed. But look at the actual construction order books in the massive shipyards over in South Korea and China right now.
Right. They are building a lot more of these ships.
A massive wave of brand new, highly efficient FSRU vessels is scheduled to come online and hit the water in the next 3 to 5 years. The ultimate bear argument says that global supply is inevitably going to catch up with and then vastly exceed demand.
And when supply exceeds demand in a commodity transport market?
The daily charter rates absolutely crater. If those charter rates drop by, say, 30% across the board, Accelerate's beautiful 48% gross margins will implode back down to 15%. And remember, that return on invested capital metric we analyzed, it's barely clearing their cost of capital right now during the absolute boom times.
So if rates drop,
their economic returns turn deeply negative. If you buy the stock today at $42, you are essentially buying at the absolute peak of the cycle, tricking yourself into thinking it's a permanent new plateau. That is the classic fatal mistake in maritime shipping investing. You buy the stock when the PE ratio looks really low and safe, but that's exactly the moment when you should actually be selling because earnings have peaked.
Because the future earnings are about to fall off a cliff?
Exactly. That is the cyclical trap. You get lured in by the current yield and you get crushed by the macro cycle.
That is a very sobering thought. It definitely puts the whole impenetrable utility fortress idea to a severe test. So let's bring it all home. The final verdict. How do we synthesize all of this conflicting data?
After looking at all the pillars, I'll give the business a quality score of medium.
Why only medium, given those margins?
It has incredibly strong free cash flow conversion, which I absolutely love, and the core sovereign customers are demonstrably sticky. But that intense capital requirement, the unavoidable fact that they have to constantly spend hundreds of millions of dollars just to maintain and slightly grow their earning power, it intrinsically caps the ultimate quality of the business. It's a heavy industrial play. It's not a highly scalable software business. You will never, ever have infinite returns on capital.
And the valuation score today?
Fair, just firmly fair. At $42 a share, you are getting exactly what you pay for. It's a reasonable price for a reasonably good business. There is no free lunch here, no hidden deep value.
So where does this narrative go in the next 5 to 10 years? What is the realistic future outlook?
Their long-term success as an investment hinges entirely on management's ability to execute that integrated project strategy.
The pivot away from just being a landlord?
Yes. If the executive team can consistently pull off more complex deals like the one in Jamaica, where they successfully morph from a simple vessel renter into a true toll road utility owner that controls the downstream power, then this stock works over the long haul. It slowly becomes a highly stable, dividend-growing compounder. They actually widen the economic moat.
And if they don't?
If they fail to secure those integrated downstream deals, if they just take the easy route, keep buying new ships and renting them out on the spot market, then they inevitably revert to being a pure commodity shipping company. And participating in a capital-punishing cyclical sector like maritime shipping without a moat is a very, very tough place to be as a long-term shareholder.
So the baseline expectation for investors today?
Expect moderate, single-digit annual returns. Those returns will likely be heavily weighted toward the dividend payout rather than massive capital appreciation. It's a defensive infrastructure play for a diversified portfolio. It is absolutely not a tech moonshot that's going to 10x your money.
So here is the final provocative thought for the listener today. As you watch Accelerate over the next few quarters, don't just blindly look at the headline earnings per share on CNBC. Watch very closely where management chooses to spend that massive pile of free cash.
That is the ultimate key to the thesis. Watch the capital allocation.
Are they taking that cash and just buying another floating ship to rent out to the highest bidder? Or are they taking that cash and buying the physical onshore power plant that the ship plugs into?
Because one of those assets is a totally replaceable commodity, and the other asset is a localized monopoly.
The difference between those two paths will determine if this stock eventually doubles in value or just goes absolutely nowhere for the next decade. Keep your eyes squarely on the capital allocation.
I really couldn't have summarized it better myself. Spot on.
Thanks for joining us on Synaptic Investing. We'll see you in the next deep dive.